Good morning. Welcome to our E3 Weekly Market Report. I'm Pat McClatchy. It is the 4th of February. Exports have just come out. Let's go straight to them. We can see there's a much larger cotton number than we've seen recently. Evidently, lower prices have stimulated this market. We've got sales of 251,600 running bales. That's 96% above the previous week and 75% over the 4-week average. Turkey took 91,700. Vietnam took 74,800. Pakistan took 18,300. But then as we look through, we've got sales for Indonesia. China took 13,700. Bangladesh. We've got quite a few countries that are in this market. Exports, actually, shipments of 233,000. That's a marketing year high. That's up 49% from the previous week, so that's a positive number. Net sales, I'm looking for next year. Small numbers there. Let's look at the reaction. Cotton market was down 35 in March, just before this number came out. It's down 30 right now. It's firming up some here in the early going. Let's look at soybeans. Net sales, actually a negative number, a negative 43,600. That's a marketing year low, noticeably lower from the previous week and the 4-week average. Spain took 102,400. Netherlands took 73,300. Japan took 57,900. And we had a very large unknown destination cancellation of 374,900. So let's see the reaction. The bean market was up 3 3/4 just before the report came out. Right now it's up 1 1/2. So it is weakening off of the report. Corn number looks to be a big number, 1,129,100 metric tons. That's up 38% from the previous week and up 56% over the 4-week average. Mexico took 301,400. Colombia took 248,300. Japan took 209,300. Reaction. Corn was up 2 cents just before this report, and right now the corn market's up 2 1/4. Looking at wheat, 66,200. That's a low. Marketing year low. That's 78% from the down under the previous week and 74% under the 4-week average. Yemen took 32,000 metric tons. Mexico took 14,200 metric tons. Trinidad took 7,500. Looking at the numbers here, we've got wheat was up 2 just before the report. Right now, wheat's up 1 1/4. So very good number in cotton, good number in corn, weak numbers in soybeans, and also a light number in wheat. The cotton market is down 20 right now. As I mentioned, when the number came out, it was down 35, so we are strengthening some. We want to talk about let's just talk a little bit about recent activity, recent being yesterday. Had a very large sell-off yesterday in the dollar. At the same time, we saw the crude oil market rally a couple of dollars. We've seen good support, it seems, in recent days in the crude oil. Looking at the dollar, with yesterday's sharply lower dollar, you're quite a bit lower today. The dollar is down 95. So we're seeing a really good drop in that market. As we've talked about for some time, the value of the dollar is will have quite an impact, positive or negative, in exports of crops, these agricultural commodities that we watch. And so even though the reaction doesn't show up on this board immediately, it should show up, and it should be a positive influence for the market. These lower prices also for cotton, for instance, it appears we're stimulating demand, so that's a positive thing. So there's some things going on in these outside markets that have been so influential in recent months that are looking to be positive to these markets. We'll see. We're going to talk about a subject. Some people have asked, we have quite a few farmer watchers of our program and listeners of the Ag Market Network, and many of them have asked the question about, and many of them do this, they buy back their crop on the board, typically harvest during the fall and early winter is when we are making our lows for the year. That's the way the seasonals usually point, and then the highs are made during the spring and early summer, sometime around planting time. And so many farmers will sell their crop because they need the money, pay off loans, and then sometimes they'll buy back the crop on the board to re-own it, either through futures or options. And we want to look at a couple of examples here on how that works. I know this could get a little boring, but just bear with me. We're going to look at a couple of examples for corn and look at a couple of examples at cotton. The first we'll look at corn. Corn right now in July, and that's the month we're going to use, is trading in the area of 380, let's see, 383. And looking at the possibility that between now through February into the spring, we could see as much as a 25-cent rally in corn. What could a farmer do to buy back his crop? Well, looking first at the futures, if the market rallies 25 cents and a farmer's bought back his crop, theoretically you would expect to make 25 cents to add back to what you've made for your crop. That's the way that works. The negative for that for many people is the margin exposure, because you do have to post margin. If the market goes against you, then you would have to put up more money. Another alternative in corn would be to buy calls. And the way that would work, you would go to July and buy a 390 call, which is just out of the money, practically at the money. The way the call would work is when we checked prices just minutes ago, a 390 call was going for about 17 cents. That means that someone would buy the call for 17 cents, pay that amount of money. They would not be exposed to margin. As far as what could be made on that, an at-the-money option has a delta, I'll explain that, of 50%. And that means if futures move 10 cents, that option, an at-the-money option, will move half that, or 5 cents in the case of corn. So it doesn't move as fast as futures. You don't make as much, but you don't have the margin exposure, and that you don't have the possible margin calls. So if we get a 25-cent rally there, buying a 390 call in corn costs 17 cents, you should expect to make somewhere in the area of 13 to 14 cents, or about half what futures would do. The next example is called a fence. This is with options. This is also called a combination. We would, in this particular case, go and buy the same call we did in July, buy a 390 call, and we would do another thing. We would sell a 350 put. You're paying for the call. They're going to give you the premium for the put, and that reduces your exposure, or that reduces your cost. The 390 call, you pay 17 cents for it. A 350 put, they're paying you. They pay you 6 cents. That's an 11-cent cost. The delta on this is higher than an at-the-money option, because as the market rallies, if it's going your way, it can go against you, but if it's going your way, the total delta is around 68 points. So you're going to be making 68% as much as futures do. So it makes more than an outright call. It costs less than an outright call, but the bad is it does have some margin exposure. It's not the same amount as futures outright, but it does have some. It's sort of a hybrid or of the two. It's sort of a compromise between the two. Some margin exposure, better precipitation on that, participation. So the three examples: buy futures, buy calls, or buy a fence, buying a call, selling an out-of-the-money put. That's corn. Let's look at cotton. Cotton, July futures are trading right now at 60, in July, trading at 62.55. If this market can rally into the area of 67 cents basis the July, between now and maybe early summer, if you buy futures, then that's what you would hope to be able to make, is that amount. 465 points you would be able to make back on your crop if you bought futures. At the money calls, a 63-cent call when we checked just before a broadcast was costing 225 points. That's what you would put up For a 63-cent call. The delta on it is almost 50%. So with a move of 465 points in futures, you could expect to make about 240 points on that call, just the call. Again, you don't have the same exposure you do with futures. Let's look at the option fence, the combo. Buying a 63 call at 225 points, you would sell the 58 puts at 90 points. That's a total cost there of 135 points. And the delta on the call that you buy is 48. The delta on the sell, on what you sell, is 22 and a half. So you have a total delta of a little over 70 points. So if futures rally 100 points, a 70% delta would mean you would make 70% or 70 points. That's the way that works. Again, you have complete exposure on futures. You have what you put up if you just buy a call, and then on a fence, you've got some exposure also if the market goes against you. So that's just a couple of examples. That's something people do, and I thought I would touch on that. If you have any questions about specific markets and would like some ideas, you can go to our Facebook or Twitter account for Ag Market Network, and we'll be happy to respond to it. So please feel free to ask questions there. That's really it. Let's just kind of go back over and wrap up what our reaction has been since our exports have come out. Good exports in cotton. We were down 35. Right now we're down around 25. The soybeans, when the number came out, and it was a very poor number, a negative number. It was up 3 3/4 before the report. Right now it's up a penny. Looking at corn, a good number there. That market was up about 2 cents. It's up about 2 1/4 to 2 1/2 right now off of a good export report. A weak number in wheat, and the market there was up 2 just before the report, and now up 1 1/4. So that's really it. That's exports for today and reaction. We thank you for being with us for the E3 Weekly Market Report, and I hope you'll join us later for our afternoon update. Thank you.